Hi, you're watching Russell Market Week in Review for the week ending February 20th, 2015. We're coming to you today from Russell's world headquarters here in Seattle, Washington. I'm Mark Soupiset, and I'm joined again this week by Erik Ristuben, our Chief Investment Strategist. Erik, good morning.
Good morning, Mark.
Thanks for being with me. Let's start, if we can, across the Atlantic in Europe, where Greece at least is trying to get a loan extension from the ECB, and Germany this week said, over our dead body, effectively.
Well, yeah,
Talk about that.
It come a little bit off the initial reaction, which was very dismissive.
Yeah.
Look, at the end of the day, we still think what we've been thinking about Greece, which is that eventually a deal is going to get done. It's going to get done in the 11th, maybe the 12th hour. I mean, it is going to be a late deal. They're both jockeying for negotiating position. Okay. There's still some time. I mean, they can make it through February, but in March, Greece has to pay some debt back. They may not have the cash. I mean, that's kind of what they're looking for is, a little extension. Can you float me a little extension so I can make my payments?
So more about time than money, really?
It's more about time than money right now. Okay. But eventually they do need a deal, right? And the reality is that it serves neither side's purpose for Greece to exit now. Right. The Greek populace likes being in the euro. I mean, when they polled it before the last election, 70–80% of Greek citizens said they want to remain part of the euro. So I don't think the Syriza government has the kind of political backing within Greece to actually go over the brink. Okay. I think they push it to the brink, and eventually there's going to be a deal done.
And you think that'll stay the course? In other words, you don't expect Greece down the road to exit?
Well, not in the kind of near future, but yeah, maybe over time. Yeah, that definitely could be a possibility. The big thing about this one, in this version of the Greece issue, is that the contagion effect really isn't there. Right. The news is covering Greece, but the market's really not doing much. Right. Spanish yields are at a little over 1.5%. Italian yields are at 1.6%. Portuguese yields are at 2.22%. So you're not seeing their spreads, their yields get really, really high. Right. So really, there's not a lot of angst right now about a Greek problem, systematic problem for Europe. All right, good.
Let's shift gears then, come back here to the U.S. I want to talk about the Fed Open Market Committee, the minutes that we saw. What did that tell you about? Are we dovish? Are we hawkish? Is there some dissent, or not dissent, but some disagreement within the committee about where we should go with interest rates?
Well, yeah, the Fed watching, the sport of Fed watching is completely up and running.
I have season tickets now.
You should have season tickets. Yep. And really, whatever they do, whenever the notes come out or the minutes come out, people start dissecting every possible angle and every word, every syllable. They start, parsing sentences. The reality of the situation is these minutes clearly reflected that there are some members of the Open Market Committee that are saying effectively, well, oil prices are really down. European growth, although improving, has been softer than we'd like it to be. Maybe Chinese growth hasn't been as strong as we'd like it to be. And inflation in the U.S. is almost non-existent. In fact, basically non-existent. Why are we going to be in such an all-fired hurry to raise rates again? Now, the reality of the situation is the form of inflation that the Fed is going to concentrate most on is wage pressure causing inflation. Right. And wage pressure is likely going to be caused by full employment and fuller employment, and we still think that is likely to become an issue by the third quarter of this year. So we still think the Fed is probably likely to move in the third quarter. It may be starting getting later in the third quarter, maybe even to the early fourth quarter, but we still think they move this year.
All right, we'll keep an eye on that. And then lastly, shifting gears to Asia, and I wanted to ask you about Japan, where the Nikkei, I thought, had a pretty good week, up a little over 2%. What drove that? What should investors be looking at specifically with regard to Japan?
A couple of themes that we've been talking about on a couple of these programs. One is the strong dollar, and we've been talking about that creates a headwind for the U.S. economy, particularly in the export economy. In the fourth quarter GDP number, we saw that exports are down in the U.S. But it should be a tailwind for Europe. Countries like Germany, who are big exporters, actually, they saw exports increase in the fourth quarter. And I think the biggest news out of Japan this week was they had a very strong export number in January. And those exports were going to other Asian countries and the United States. So the yen is cheap. They're exporting good. Their export goods are looking attractive. So you're getting a little more traction in the Japanese economy. I think that made people feel better about the economy, and then obviously better about stocks.
All right. Erik, as always, I appreciate your time. Thanks so much for being with me today, and thank you for joining us on Market Week in Review. We'll see you next week.